We've got 7,300 just holding on the FTSE. We are down by 0.5% on the French market. The DAX, as we talk about the story around Daimler Trucks, it is expected potentially to be a constituent of the Xetra DAX. You are now hearing the bell being rung for this Daimler truck listing, and that is the CEO, Martin Daum, as he is heralding this huge moment for Daimler, but also too for Ola Källenius, who is the chairman, and you can see also the man steering the cars, vans, buses division, along with the very big say in this trucks division. So it's a key day for him as well, and you can see sharing of this big moment for all the executives there on the ground. They're hoping that this realignment will lead to greater profitability in the business. They are hoping that more independent strategy can mean a more dynamic business across the board, from cars, trucks, vans to buses, and they're all sharing in this journey, which does tell you about a story of independence when it's more than just one or two people ringing in this bell as well. We are going to be hearing from the CEO of Daimler Truck in just a few moments. Ola Källenius, the CEO, and Daimler and Mercedes-Benz boss will also be joining Street Signs at 10 CET. So all of the big executives will be joining us, and look at that, such a big moment for the business at this stage. And we know is a huge transition moment for some of these big auto giants as they battle their journey towards electric vehicles, and of course try and be at the forefront of that journey. Now, a quick look again at the basket of auto stocks, because what we're seeing is a huge play for a lot of traders here at this stage. I'm going to take you back over to this side of the chart, and you can see BMW trades down by 1%. Daimler now down 15.1%. Volkswagen is down. All these stocks, in fact, trading lower, as you can see. Stellantis, which is one of the other big giants in the room, it's down 0.5%, and Renault is down just modestly at this point. But perhaps we will be just repositioning with one extra chart on this board soon that says Daimler Trucks. So I'm just going to push on as we continue to take these live developments for you. Bayer has won a second consecutive verdict on its top-selling Roundup weed killer. This is quite instrumental for the company, for the stock, as a jury in California rejected a mother's claim that the chemical giant's product had caused her cancer. The stock rallying at this point. You can see Bayer up 2.5%. Shell is meeting with shareholders today to vote on a string of new simplified corporate proposals. It's vying to ditch its dual-class share structure and move its headquarters and tax residency to the UK. And elsewhere, UniCredit shares hit a new 22-month high after the Italian lender's chief executive, Andrea Orcel, unveiled a new 3-year strategy aimed at expanding share buybacks and dividends. He also said the company was in a position to evaluate new potential mergers and acquisitions. 2 months ago, UniCredit's, you may recall, pulled out of a deal with the government to prioritise rival Monte dei Paschi di Siena. And elsewhere, we are going to take a quick look at the broader German market. What we've got at this point, German inflation rose at its fastest pace in almost 30 years in November, posting a harmonised increase of 6% year on year. Energy prices were up more than 22% on year, reflecting a wider trend across Europe. The DAX, you can see, 1/3% weaker. But again, these developments around Daimler, very pivotal for the DAX in trade today. I want to push on, and elsewhere on the data front, we are setting up for a huge day stateside. US November CPI is expected to have jumped 6.7% on the year, according to Dow Jones. The latest print is due out at 14:30 CET. So we are seeing, again, market stateside just now regrouping, a little bit more green on the S&P and NASDAQ versus all suggesting a slightly weaker start today. So it's a cautious old day, a little bit choppy in the early action, as you'd expect. But the big story in Europe here is really around Daimler and Daimler Trucks, as we have seen the listing a little bit different around this company coming to market, to the spinning off that's been taking place from the wider Daimler business. That does put the focus on all of the individual parts: Mercedes-Benz cars, the vans, trucks division, buses. We were going to get a huge focus on these independent parts of the business from here on in, it seems. Jeff.
Yeah, I think it's a very interesting day to see this business being spun off. And of course, it suits the current trend for some of the parts realization that we're seeing across a whole slew of industries here, an opportunity to break up the conglomerate model and to try and realize value for shareholders. And of course, the nice thing about the way that they've done this is to a certain extent, although nobody wants the share price to fall on the first day, to a certain extent, they have insulated, if you like, the listing process by going for this spin-off approach rather than going for the IPO, which obviously is more vulnerable to the volatility we see in markets. But I just want to make a point here. As we look at the relative valuations of these companies, Karen, it is remarkable what premium electrification has given automakers who have that primarily as a theme. And obviously, Tesla is a $1 trillion market cap company as we look at its valuation. But you look at a business like Rivian, for example, that might be seen as a direct competitor to Daimler Trucks. Rivian is arguably on market cap terms considered to be more valuable at something like $98 billion, having barely delivered a vehicle than the whole of Daimler AG. And that is extraordinary. And that is something perhaps that we can see corrected by Daimler Trucks ultimately, as long as it continues to drive this message that it is an EV and a hybrid vehicle builder. Maybe at some point here, the market will take that on board and we will see a re-rating of these European OEMs that are very quickly shifting their manufacturing and their structure to sell electric vehicles and to address that market opportunity. Annetta, I think you've got a conversation with us with a very important executive this morning. So let me hand it over to you.
Yes, exactly. Thank you so much, Jeff. Yes, I'm here first, CDC, who is the CEO of Daimler Trucks. So thank you much for joining us. So the first prize is 28 euros. Is that what you were expecting?
I mean, it's always the most important part of a spin-off, because that's really the shareholders deciding what the value of the company is, getting the shares to this full range first price.
Let us look at your strategy and also the way you want to boost profitability, because there you're clearly lacking behind competitors. So what are your plans?
I mean, first of all, we have profitability and we have profitability. Yes, we are lacking to some competitors, but only in some areas. Other areas are absolutely benchmark in the industry. So I have absolutely no doubts that we will catch up with everything else.
Start a cost-cutting program to get your profitability up?
No, we already started 2 years ago, and that has nothing to do with the spin-off. The spin-off just gives us more focus, more visibility, an interview like that, yeah, and going forward as a leading transportation company.
We were just discussing your way forward into making trucks cleaner for the environment, obviously. So you're having a two-fold structure, right? Electrifying and hydrogen. So what is
very important? Green energy. If we can do that everything in the grid, then certainly there's an advantage of battery electric trucks. But if we need something in between to store and transport green energy, then that is hydrogen.
We have been having a few problems with the line, as you can see, and it feels as though we've now just dropped out completely. Apologies for the challenges there, but we wanted to take it as much as we could because it's such a huge story unfolding out of Germany today. And just to recap, we've had this 28 euros on the market debut for Daimler Truck. It's a monumental moment for the company as it takes another direction around independence in the various parts of the business. So 28 euros the starting point for that share market action. Shareholders in Daimler received 1 share in Daimler Truck, and this is now the world's largest truck maker by revenue. So 1 share for every 2 Daimler shares that they own was what they ended up with. And this is where we're at, 28.96. So it's moved forward even on listing at this point. But Jeff made a very good point a moment ago that there's been a lot of appetite in the sector around the transition, and we've seen it through the lens of some of the big US operators. We are going to try our luck with this line again because we do really want to hear from Martin again. So let's just listen in.
It's relief on the toll side compared to someone who is burning diesel. So I think there will be a way that customer TCO parity, we call that, to run a zero emission truck. I'm not worried about that at all.
Looking at your order book, where do you see the biggest growth? Like, is it the States? Is it Asia?
No, it's all over the world. You've seen it here on the floor here in Frankfurt.
Unfortunately, we are just learning more about German Wi-Fi and telecommunications at this hour rather than the trucking business. A lot of dropouts, but as you can see, there's a lot of people on the ground there, so perhaps a little bit of an overload to the system as people are using their mobile phones and devices to communicate this event. But it has been a positive start as we've seen an increase from the 28 euros starting point, and it continues to track higher. So Daimler Truck now at 28.79 in markets. So that is one we continue to watch this morning. Hopefully we can bring you more from that interview, and perhaps we can even turn it around during the course of the morning too. Coming up on the show, the UK's Conservatives slide down the polls amid allegations of parties at number 10. Somebody's having a party. More after the break.
Tune in for Tech Chat.
Flipping on the UK stock market this morning, just notching below 7,300 points. That is where we are trading at this point. So we've given up another level on the market. So UK economy grew by a weaker than expected 0.1% in October, weaker than a pre-pandemic reading of 0.5% in February 2020. UK Chancellor Rishi Sunak says the economy is well placed, but that there could be bumps in the road. The weaker numbers come as the Bank of England ponders whether to hike rates at its meeting next week. And a look at some of the UK home builders at this stage, it's a mixed bag. We are seeing a gain for Barclay Group, 9/10 North, Persimmon trades in the green, but weakness there, as you can see, a little bit of it on Bellway, about 0.25% in the red, Jeff.
Yeah, let's talk some more about the situation the UK government finds itself in here, because it's on the one hand fighting this latest COVID variant, but at the same time shooting itself in the foot as quickly as it can. The UK Prime Minister is now facing a potential rebellion in Parliament over Boris Johnson's decision to implement stricter COVID protocols. Several Conservative MPs have already said they will not vote for the proposals when they are debated in the House of Commons next week. The UK government Plan B measures include mandatory face masks in most public indoor spaces and the introduction of COVID passports for large venues. Johnson's Conservative Party has now lost its poll lead to the Labour Party amid controversy around allegations of festivities and parties at Downing Street last winter while the nation was under strict lockdown conditions. The latest YouGov poll for the Times newspaper shows the Labour Party up 4 percentage points to 37%, while the Conservatives dropped to 33%. Karen, there is this terrific word that ultimately came out of a drama, I think, and it is omnishambles. I think it is one word rather than two words, but it is ultimately what Boris Johnson's party is facing, because there isn't just this issue of whether parties were being held, as we are led to believe by this sort of tearful resignation from Allegra Stratton, who was working in the press office at Number 10. But there's this ongoing saw of exactly how the redecoration of 10 Downing Street was paid for. And that, of course, is connected to party donors and has raised some concerns about a breach of the rules as to who can pay for these kind of things. So on the one hand, Boris Johnson's press team are trying to stamp out the fires around who paid for what. And on the other, they're facing immense criticism over now the possibility that there were 3 parties held in Downing Street while the country was under very strict lockdowns. And this story isn't going away. It does seem to be getting bigger. And at this point, as Boris Johnson takes paternity leave today, we are unable to hear from him, of course, as to what comes next. But it is interesting that a slew of cabinet ministers have been wheeled out in front of the press to try and address the criticism. And people like Matt Hancock, of course, have actually said, I wasn't there. And Sajid Javid said, I wasn't even in the government at the time. But at the moment, Karen, this story is increasingly raising the stakes, I think, for this party and for this government. And Labour, inevitably, as you would expect, and as they should, are using every opportunity they can here to pick up voters.
Jeff, never has wallpaper, wine and cheese been so fascinating. I mean, we've seen all this have a very long life in politics, right? I mean, the wallpaper issue and the redecorating at Number 10, we've been talking about for months and months, and it felt as though it had faded a little bit, but it's back right on Christmas as we talk about those glitzy decorations and who paid for what and what Boris knew. It seems very UK-centric, but it could take on a different turn if we are talking about some form of an impact on politics. I think the other point you make here around the lockdown breaches, it feels that it could have been just a little bit water under the bridge. The problem here is that we're going back into stricter requirements to try and tame the variant, and it's very hard for the government to have credibility when there were breaches. And it wasn't just one breach, as we know, it was a series of breaches which very much irritated the public that tried to follow the rules broadly. From the very beginning. And now as we talk about this giggling moment around wine and cheese, whether it was a business meeting or not, and whether it was a way to circumvent rules that were imposed on the rest of the country, it's very hard to be talking about plan B and potentially even plan C to tame the variant here. And just digging into the detail, a lot of people overseas may have given up on trying to track where we're at with these restrictions. But, you know, we're talking about having potentially to check in to pubs and restaurants using an app, and that seems pretty seamless and easy. But last time around when that happened, a lot of people got pinged, and this was the pingdemic that happened, that they had to self-isolate, stay at home, wait to see whether they'd had a COVID infection, which caused a huge amount of disruptions to business across the UK. And, you know, at this point, if we're talking about being pinged, we know that goes with other rules that suggest that if there's been some form of infection, you need to take lateral flow tests before release, which again drives up costs for for businesses, but also for people just wanting to go about their business. So, Jeff, I think it is incredibly challenging for the government to get a handle on this COVID narrative at this stage.
Yeah, and there is this sneaking suspicion, and I think hopefully it is not the case that this Plan B program was announced and introduced as a way of diverting attention from this very serious question of whether the rules were actually broken in number 10, and also what the Prime Minister ultimately knew about how his wallpaper was being paid for. There are many things I think that the great British public can put up with, but being consistently lied to is not high on that list. I just wanted to also think about for a moment who potentially could replace Boris Johnson if this ultimately leads to him having to bow out. And according to the Mirror, that's quoting the odds from Ladbrokes, at the moment, Rishi Sunak, the current Chancellor, is still favoured. The odds currently 9-4 that he could be the next person to replace Boris Johnson. And interestingly, Keir Starmer is in second place in terms of assessing who ultimately could be the next Prime Minister of the country. But that would suggest that this becomes more than just a replacement of the leader of the Conservative Party and therefore Prime Minister, but ultimately leads to a going to the public, if you like, for a general election, which I don't see on the cards at this stage at all. But I think it's very interesting that the odds still have Rishi Sunak there as a potential replacement, because there are obviously a number of other talented ministers in that cabinet, like Sajid Javid, who potentially could be popular with the public. Anyway, let's wrap up for the time being on this conversation. Your thoughts always welcome if you want to weigh in, but we will take a quick break. When we come back, coming up, Bitcoin slips overnight as investors stay away from riskier assets and watch out for US inflation data. We'll talk a bit more about that when we come back.
We put
Debuts at 28 euros a share. We'll hear more from CEO Martin Daum, while Ola Shalenius joins us later on this morning. China's auto sales continue their recent slump, down over 9% in November, but new energy vehicles are still surging, up 122% on month. European markets trade lower as German inflation jumps more than 5% in November on the year, while US CPI is expected to hit levels not seen since the early 1980s. And UK GDP comes in weaker than expected, barely growing in October, while Prime Minister Boris Johnson comes under increasing pressure over allegations of COVID breaches. Let's take another look at these European markets that have been trading for 30 minutes so far. And we've been setting up for a fairly cautious day of trade, given we've got US inflation out later on and big numbers expected, 6.7%, according to some forecasts. So markets are reversing. Another big feature has been the German listing of Daimler Truck. We have been closely watching those developments, but it's moved a lot of bits around the auto basket and, of course, a lot of trade in Daimler as well. So the early picture, we are travelling south still by just under 0.4%, a little bit less off the UK stock market. The FTSE is only down 0.2, but the CAC is down a little bit more, just over 0.4%. And let's get to the sectors. We are seeing at stage the green move on to the boards for real estate and basic resources, two areas of the market that are supported at this stage. Technology trades weaker by 0.9. We saw that right from the outset. The recovery trade has run out of steam today in that sector, which has been moving very quickly with its US counterparts. Retail stocks are a little bit weaker too today. The stocks, big ones on the move to the upside. Doc Martens again flaring up on the top boards, 3% higher. We've got Daimler AG right at the bottom as anticipated, given the outsized moves around this reorganization, 17% down on the stock currently. HelloFresh, delivery platform, also trades lower. It shed 3.8%. Elsewhere, Ashmore is down more than 3% too. I want to take you to Bitcoin, and let's just take a quick look at the early trade. You can see we are perched higher. Nice bounce of 0.9%, not much compared to what the crypto crowd are used to. When we see bounces, we really do see big moves, but it's a normal range of asset class moves today. Bitcoin has recovered slightly today after falling over 5% overnight. This amid lower appetite for riskier assets among investors who are awaiting the US inflation data out today. Our next guest says all eyes will be on central banks next year to see if they are bold enough to launch their own digital equivalent to cash. And joining us now to discuss his outlook for digital and crypto assets is Richard Gendel-Brown, Chief Technology Officer at R3. Richard, I know a lot of people in the crypto industry are quite keen to separate this out from other asset classes, but the reality is when we've seen market-moving events impacting the technology sector, there's been a correlation with Bitcoin. So just set the scene for us how that continues into 2022 as we talk about potentially a retreat from extraordinary monetary stimulus.
It's a good point because, as you say, the focus of my firm is on applying the underlying technologies to problems in business, and it's undeniable. In 2021, the crypto world, and not really Bitcoin, but the other assets, they really did all the running, both from a price action perspective, but also from the innovation that was happening underneath that. There was a lot of things that were being first prototyped or delivered in the crypto or the decentralized finance world that have been watched closely by the enterprise world where I work, where my firm works, and which have been used as inspiration for some big projects that I think we're going to see launch from the incumbents, from the centralized finance firms next year.
Richard, I spent a little bit of time at Money 2020, and one of the big messages from the payments firms and the fintech players is that they just couldn't figure out how to make Bitcoin work as a means of transacting. It was too slow. Any workarounds effectively meant you lost the decentralized nature of the technology, and everything just became centralized, which again takes us back to the initial security and problems that other payments have. So where do we go to from here? Do you think there'll be further developments or breakthroughs in 2022?
Yeah, it's a great point, and maybe this is why there's so much interest around central bank digital currencies. Because to take your point, Bitcoin, it's been around for 11 years now. It was kind of, if you like, the prototype that showed the way for lots of other things. But at its core, the idea was, can we take this idea from the physical realm, cash, where I can go into a store, I can pay, and that transaction is instant, final, it leaves no trace, and nobody can stop me. Can we achieve something similar in the digital realm? And things like Bitcoin showed that we could. But there were some problems. That first prototype, if you like, it was slow, it was expensive. And of course, transactions were denominated in Bitcoin, not pounds, euros, dollars. You look at the debates that are raging in the worlds of central banks and the commercial banks who work with them. They're saying, well, if some of that insight is correct, if physical cash begins to decline to irrelevance, do we as societies, do central banks, do they have an obligation, do they have an obligation to provide those cash-like properties for private transactions, for permissionless transactions within limits, within bounds? Do they have an obligation to provide that to citizens in the digital realm? And that's really at the heart of the retail central bank digital currency debate. Can we do that? Should we do that? And if so, how do we put the right limits around it so that it doesn't become a haven for financial crime and fraud?
Richard, we look to price action for confirmation of particular characteristics. And I think you know where I'm going with this. In terms of the stability of an asset, you look to that stability around price action for confirmation that this can be a store of value or even a medium of exchange. It's been a torrid week. What do you think, if anything, the volatility we've seen in crypto assets tells us at this stage about the willingness of societies to accept these currencies for these roles?
So I guess there's two or three aspects there, aren't there? So the willingness of society to accept these tokens as currencies, I think the jury is clearly out. That's not what they're being used for any great degree of any great degree at all at the moment. People aren't paying with these currencies. My sense is the reason why there's so much interest in them, aside from any speculative aspect, is the permissionlessness of some of these transactions and these protocols means it is possible to experiment with new ways of doing finance, new ways of trading, lending, different ways of building transactions. And that's what people are betting on. Different. If you dig beneath the individual tokens, you see there are very different protocols, different projects with different bunches of engineers, some really quite specific problems they're trying to solve. People are in effect betting on which ones will be right. But if you then sort of pull back and say, well, what can we learn from that on the centralized world? You see this with things like the Swiss digital exchange that launched this week, what DTCC is going to be doing next year with their Project Ion, even the Australian Stock Exchange. Whilst all this has been happening, the centralized world hasn't just been sitting idle. They've been watching, they've been learning, and they've been quietly building. And I think one of the big things for next year is people are going to be really surprised when things like Project Ion at DTCC, when the Swiss digital exchange really rolls out, that these firms haven't been idle, as I say, for the last few years. They've been learning from these experiments and building themselves. So the price action for me is, I use it as a signal to signal for innovation and interest. Which of these projects are doing something novel? That's where I focus my attention as a technologist, as the CTO of the firm. But to your question about currencies, I don't think anyone would pretend these things are being used to buy and sell real world goods. That's not what this is about at the moment, as far as I can tell.
Yeah, fascinating. And we should, of course, point out that your business has provided that DLT platform for the SDX so that people understand why you've referenced the Swiss exchange.
Yes,
well, on Monday, we spoke to Dr. Eswar Prasad from Cornell University. He's the author of a book called The Future of Money: How the Digital Revolution is Transforming Currencies and Finance. And he made a very bold claim. He said, basically, there are going to be digital currencies, but it won't be Bitcoin. Bitcoin ultimately will go away. I wonder what you think of that. And can I ask you then, are we basically waiting for a fully fledged central bank currency before we can see how this whole sector evolves next?
I think we'll see both. So it is undeniably the case that we'll see central bank digital currencies because some of them have already rolled them out. The ones that have rolled out so far don't, at least to my mind, have the characteristics that make them true digital cash replacements. They're mostly centralized and require authorization. If you like, their first, to coin a phrase, maybe their first generation CBDCs, but they're pointing the way. And I think the reality is, most people want to transact in the currency of their own country or their own currency area. So the idea that Bitcoin or something like it will become the means of exchange for mainstream economies, that's fanciful to my mind. But that's not what it's about. Even if retail CBDCs, as I believe they will, roll out in every major currency, that doesn't negate the value or interest of the cryptocurrencies. They're valuable experiments, valuable alternative asset classes. There's space for all of these. It doesn't require one to win. If one wins, it doesn't require the other to lose.
Richard, thank you very much for joining us today. I really appreciate your insight. Richard Gendel-Brown with us, Chief Technology Officer at R3. Quick look at US futures now as we head to break. You can see a little bit choppy before the start. This ahead of a key inflation read. We'll dig into those expectations ahead.
Welcome back, everybody. US futures holding steady ahead of this key inflation print we'll get stateside then. November's consumer price index is expected to have jumped 6.7% on the year. The latest print is due out at 14:30 Central European time. If forecasts are correct, it would mark a near 40-year inflation high going back to 1982, only 2 years before that. Fed Governor Paul Volcker had raised prime interest rates to historic highs of over 20%, exacerbating an ongoing recession. So fascinating, Karen, that we get these numbers then on a Friday, and 6.7 is what's been penciled in here. But I think the whisper concern number is obviously 7%, which I know some economists think we will achieve at this point. And at the moment, it does look a little bit binary. And I'm interested in anybody who might take a different perspective on this. But at the moment, it does look as though if it's higher than 7%, that is cause for further risk-off behavior. Anything that comes in at 6.7 or lower, I suspect, is just going to encourage people to believe that there is still some opportunity here as far as the Federal Reserve, its tapering plan, and the earliest date that we might see an official interest rate hike.
We're going to get a little bit of movement in some of the various asset classes, aren't we, if we get a red hot number? What's been fascinating is the ascent we've seen in technology stocks this week, despite the fact we're setting up for this inflation number at the end of the week. And as we talk about, typically, if you have the prospect of changes to the rate setting environment, that is a negative for the technology, the high growth area of the market that trades on big multiples on future earnings. And this week, FANG stocks have rallied more than 4%, 4.3%. So they've been on pace to break a 3-week winning streak. So it's been a very strong performance. Somewhat left behind have been the banking stocks, only up roughly about 1.8% for the week. So we may get more movement at a basket level, which is going to be quite key at this stage. Also, any surprise to the downside? I mean, that would be quite fascinating. I know a lot of commentators have been talking about the fact that we're getting more improvement in supply chain logistics. Bottlenecks are starting to free up a little bit, which should take the pressure off some of the inflation side that we're seeing, and not to mention the oil price as well. That's going to be quite instrumental as we talk about second round effects. So it is a fascinating day. And typically we talk about this market reaction on Friday around the non-farm payrolls that crosses at this particular time of the week, and always makes it tricky for investors globally that are sort of shut up shop, gone home, finished trading for the week. But it gets us pretty much all on alert over the late day of trade here and into the evening to see what the market reaction is going to be like stateside, Jeff.
Yeah, I mean, the fascinating thing is around the anchoring of inflation expectations here. And let's be very clear to our audience, what the Fed is most concerned about is something like a wage price spiral, that these headline increases in prices ultimately feed through into consumer expectations or worker expectations, should I say, about salaries and salary growth. And it is worth just pointing out that the Atlanta Fed's wage growth tracker shows the fastest overall wage growth since 2007. But clearly that number is still running behind the headline CPI figures. So you could argue that that indicates that there is still room for wage expectations to rise at this stage. But this is the critical issue. Do employees and those looking for jobs feel emboldened enough to demand higher compensation now on the basis of higher prices paid in shops for goods and services? And that's really where the Fed is very focused, because that would suggest that there is an unanchoring then of more modest inflation expectations. And we already know, I think, from the data point we saw yesterday in terms of people signing on for unemployment benefits in the United States, that figure is now at a 50-year low. And that is a reflection of the fact that the labor market is incredibly tight. The JOLTS data, which is a survey of job vacancies, showed vacancies running at something like 11 million, I think, which is, again, a very high number here, and shows you, if nothing else, that there is a huge demand in the services sector for employees, but there is perhaps something of a skills mismatch when it comes to middle and professional tier jobs as well, Karen. So I think as we think about the inflation number, obviously the headlines are going to be about prices, but it's more important to take on the second degree thinking into what that ultimately will translate into in terms of wage price pressure at this point.
I agree about the complexity at this stage, Jeff. I mean, it's very hard just to talk about the headlines when there's so many different behavioral aspects here. And we've had to go at it for a number of months. I've been pointing out that I don't think that people expect prices necessarily to keep on rising, that they know that things have been impacted by the pandemic. They know that prices are elevated in some sectors, and they're hoping it's going to fall back. And sometimes people are pushing out those decisions, using the money and deploying it elsewhere and waiting out for the product or category to come back and move a little bit lower before they deploy the money in that direction. So I think you are seeing unusual behaviors. It's not substitution necessarily in its typical form, where if you can't get the product, it's more expensive, you buy exactly the same product in a slightly different brand. This is talking about moving money from one piece to another area. It's very different substitution we're seeing during this pandemic. But I'm going to park that conversation there, and we are going to move on to Daimler Truck, because the shares have been taking center stage in Europe this morning around the listing in Frankfurt. We've now climbed from the 28 euro mark to 29.76. So up and away for the shares today. And a little bit like what we're seeing out of the States when we get these listings around renewable vehicles. There's a lot of momentum. There's a lot of energy behind it. So let's get out to Annetta. We tried to listen live to your interview before with the man of the moment, the CEO of Daimler Truck. We had a few line issues, but I gather you're bringing us a little bit more of that exchange now.
Yes, exactly. Now we're outside, so the lines are a lot better. It's a successful listing of Daimler Truck, which we're seeing here today. And perhaps we first of all listen in to what the man himself had to say, Martin Daum, the CEO of Daimler Truck, whether they are happy with the first initial price.
It's always the most important part of a spin-off, because that's really the shareholders deciding what the value of the company is, getting the shares tonight in their brokerage accounts. And it's full in the range we have expected, so no surprises here. So really glad to see the first price.
Let us look at your strategy and also the way you want to boost profitability, because there you're clearly lacking behind competitors. So what are your plans?
I mean, first of all, we have the most prestigious brands all over the world. We have a rock-solid balance sheet, and we have good profitability. Yes, we are lacking to some competitors, but only in some areas. Other areas are absolutely benchmark in the industry. So I have absolutely no doubts that we will catch up with everything else. So leading the way to zero emission in transportation, and doing that with a strong balance sheet and profitability.
So it's not your plan to start a cost-cutting program to get your profitability up?
No, we already started 2 years ago. That has nothing to do with the spin-off. The spin-off just gives us more focus, more visibility, an interview like that, and going forward, a clear profile as a world-leading transportation company.
We were just early on discussing your way forward into making trucks cleaner for the environment, obviously. So you're having a two-fold structure, right? Electrifying and hydrogen. So what is the most important for you?
Both are very important, because the ultimate question is, how does ultimately society store and transport green energy? If we can do that everything in the grid, then certainly there's an advantage of battery electric trucks. But if we need something in between to store and transport green energy, then that is hydrogen, and therefore we go both ways.
How will that be reflected in your prices? Because clearly we're seeing that with the cars, they're much more expensive than normal cars. That will most likely also be the case, right?
This is even a bigger extent on trucks, because we need such an enormous amount of energy to get 40 tons up a steep hill that you certainly need either bigger batteries, or the fuel cells does not come for free either.
So in another part of the interview, we were talking as well about where growth is actually strongest. And he was saying that it's actually across the world. It's like sort of also driven by the strong demand in world trade. And that is also reflected when it comes to demand for trucks. But as well, buses are in stronger demand, especially as well in the United States. So the order book of Daimler Truck is really full. Analysts do say that they could actually get more profitable and more efficient being spun out of Daimler, because they can't hide anymore anywhere in that big conglomerate. And so it might be an interesting equity story if you want so. And you're already seeing that the shares are perceived very positively on the market. First, brokerages came out with target price recommendations of €35 and saying that it could be a success story going forward. it, given the importance of hydrogen-powered trucks and the focus Daimler Truck is having on it. In a moment time, in roughly 10 minutes, I'm going to speak to Ola Kalenius here as well and bring that first on live into Street Science. And we're going to hear about his perspective, why that whole spin-off makes sense and why they're keeping 35% of the shares. It's a 65% free float. Most likely Daimler Truck will make it into the DAX when we see the next reshuffling, because clearly the market cap is big enough. It's a huge company. And the free float is as well big enough. There are two components which you need to which you have to take into account. So with that, back to you. See you shortly.
Annette, just quickly on that, while I've got you, the movement into the DAX by Daimler Truck, if it happens, clearly something else will move out. So it's a remaking of the index of sorts if it happens. How is that being received? Because we're seeing a lot of change now around newer industries cropping up, of course, at this stage.
Yeah, exactly. I mean, we just recently had that reshuffling in September of the DAX when more health companies and also internet companies moved into the DAX. So it could well be that one of them has to drop out again, given the market cap, and Daimler Truck will move into it. So it's kind of a question what you think about Daimler Truck is it a traditional car maker or truck maker, or will it be also a tech company or perceived a bit like a tech company or hydrogen company? That is what Volkswagen actually tries to do, to move itself away from being just a pure play car company, also in terms of valuation, into another space. So I guess the jury is out where Daimler Truck wants to position itself in the future, but for now it seems that next time around they will move into the DAX.
Thank you very much for that, Annette and Drew, coverage today. I imagine the Daimler executives are going to be celebrating tonight. They looked fairly joyful as they were ringing the bell. And that's all for Squawk Box from Jeff and myself. Thank you very much for joining us this week and today. Next up is Street Science.
Anytime,
Good morning, everybody, and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. Daimler Truck makes its Frankfurt debut as the truck maker completes its long-awaited spinoff. Speaking to CNBC, Daimler Truck CEO Martin Daum outlined the motivation for the listing.
The spin-off just gives us more focus, more visibility, an interview like that, and going forward, a clear profile as a world-leading transportation company.
European markets trade lower as German inflation jumps more than 5% in November on the year, while U.S. CPI is expected to hit levels not seen since the early 1980s. Out with the old and in with the new. Shell ditches Royal Dutch and proposes a new structure as its general meeting kicks off right about now. And new German Chancellor Olaf Scholz heads to Paris in his first overseas trip, while President Macron lays out his vision for the EU. A very warm welcome to Street Signs. Daimler Truck has made its debut in Frankfurt after spinning off from its parent company. And there's a look for you at Daimler Truck shares, currently trading around at 29 euros 74. A big morning for Daimler Truck. It was a long-awaited spinoff. The CEO, Martin Daum, spoke about the spinoff with Annetta this morning and said he was not worried about the price of EVs directly impacting the consumer.
No, I would say ultimately it has to be done on the market. It might happen that transportation gets more expensive with that, but there are many factors, and the price of a new truck is not necessarily the only one. The biggest one is the juice you need to power the truck. And that's a big question. How does diesel develop over time? So we're talking here time frames 2030, 2040. What is the price for CO2? Do we have a CO2-based toll system where a zero-emission truck gets relief on the toll side compared to someone who's burning diesel? So I think there will be a way that it's cheaper ultimately for the customer, TCO parity, we call that, to run a zero-emission truck. I'm not worried about that at all.
Looking at your order book, where do you see the biggest growth? Like, is it the States? Is it Asia?
No, it's all over the world. You've seen it here on the floor here in Frankfurt. Our logo is for all who keep the world moving. You need trucks everywhere. Yeah, and as more developed the society is, as more trucks you need to haul freight, to supply your supermarkets, to make construction sites happening, to get the refuse hauled away from your house. And so I would say this is all over the world. Yeah,
do you see in the short and medium term these supply chain bottlenecks as well for your product, especially when it comes to chips?
Yeah, absolutely. I mean, this is really a very, very difficult situation, especially for our suppliers. We would have a monster market in 2022, the demand side. Normally you look at the markets and then you make your estimates for market share and then you define how much you want to produce. These days you call your suppliers and ask them how many parts can they deliver, and that's exactly your production program. And then you have to figure out how you get these small supply, allocated to your customers. So very strange situation. I hope it's getting better during 2022.
It's been a busy morning for Annetta. She's got all sides covered for us. So from the CEO of Daimler Truck to the CEO of Daimler, we'll hand it over to Annetta in Frankfurt.
Thank you so much, Juliana. Exactly. I'm now joined by Ola Källenius, the CEO of Daimler. Thank you so much. So it's a historic day for you. Are you happy with the first pricing and how the whole thing went?
Absolutely. It is a very important day for us today, sending off these two strong industrial players into their individual futures. And you don't know until you list the stock what's going to happen, but the reaction from those first trades was very positive.
What's the benefit for your shareholders?
Well, we talk about value crystallization. Many investors, they want to choose if they want to go for an industrial good truck company or a luxury and tech car company. So with this move, we give the shareholders two separate shares that they can hold and trade. And you can see that when we announced this back in February, the share reaction was up almost 10% and a solid start today. So I think the value crystallization has worked.
Let's look at another historic day, because yesterday you got level 3 approval for autonomous driving for one car here in Germany. So is that, are you happy with that? And what does it mean for your company?
It's very important. This is a brand new regulation that was created here in Germany for autonomous, where the car really takes over and the car is responsible in some driving situations. So it feels in a way like putting the first step on the moon with this first certification. And there will be more to come in the future. This is a very, very exciting technological space for us.
Let's briefly look into the future, into 2022, because currently the car industry is facing so many headwinds with the supply chain bottlenecks. Are you more optimistic about 2022?
We have managed to stabilize some of those semiconductor supply chains in Q4 compared to Q3, which was very heavily impacted by COVID-related issues. The big chip makers say that there will still be restrictions in 2022, so it's something that we will continue to work with our partners and suppliers to gradually improve. And at the same time, we have the best product portfolio ever. So demand is very strong. So we're looking forward to 2022 for Mercedes.
I remember that you once told me that your pricing power is extremely good going into that electrified market. Are you still optimistic about your pricing power for your high-end luxury goods?
Well, if you look at the reaction to the EQS, which is our flagship electric car and this brand new dedicated electric platform, the reception by customers has been phenomenal, very strong order entry. So on these first steps into an electric era, it feels right.
Let me bring you back to the IPO of Daimler Truck, because why are you keeping 35%? Why don't you just give it all away?
Important for a spin-off is that you create a majority spin-off so that there's a real stock in the market that can be traded. With 65% spin-off, we have created those circumstances. And we still, as an investor, we hold an interest in the company and can also be a little bit of a protecting minority interest. But industrially, Daimler Truck is now its own company with its own governance, and they will write their own destiny.
And Daimler Truck will also deploy another technology, a lot more hydrogen. Are you looking into hydrogen for Daimler, for the cars as well?
For long-haul trucking, where trucks go up to 1,000 kilometers a day, maybe they have to haul 40 tons, it makes a whole lot of sense to look at the hydrogen technology because of the energy density of such a drivetrain. We don't have any plans on the passenger car sides at this point. Here we're going for full battery electrification.
Thank you so much for your time and have a good day.
Thank you.
Okay, guys, with that, I'm sending it back over to you. An exciting historic day for Daimler and Daimler Truck. We'll keep on, of course, tracking how the shares are doing.
Annette, thank you so much for bringing us both those interviews. Really interesting to hear from both sides. Well, sticking with the auto sector, Elon Musk has sold even more Tesla stock, netting almost $1 billion from the sale of 934,000 shares. But he also exercised stock options to buy over 2 million shares, meaning he's now exercised options to buy more than 12 million shares since November 8th. Volkswagen has confirmed Herbert Diess will stay as CEO. Diess had come under fire following clashes with VW's labor unions after he warned tens of thousands of people could lose their jobs amid the company's transition to electric. VW's brand chief, Ralph Brandstatter, will take over responsibility for the Chinese business, while Diess will head up the company's software unit. I want to take you to an event taking place with the Bank of International Settlements, otherwise known as the Central Bank of Central Banks. It's got quite the lineup, including the ECB President, Madame Lagarde. Let's take a listen to what she has to say.
Very nicely described in the generic that precedes this moment. Cutting-edge technologies emerge by the day. New players are jumping into the fintech stage. The volume of data is increasing exponentially, as is the computing power to process it or the artificial intelligence to deal with it. Change is moving so fast. And central banks need to anticipate. They need to assess. And when useful, embrace these changes if they are to serve and protect their citizens in the best possible way, according to the mandates we have. In addition, change and innovation transcend borders. And that is why the BIS Innovation Hub, which fosters technological collaboration amongst central banks around the world, plays such a critical role. And that is why I'm delighted that the community of Euro area central banks, known as the Euro system, will soon play an even stronger part in this endeavor, in the form of the BIS Innovation Hub Eurosystem Center, bringing together the 19 national central banks. The center will play a significant role in the exploring of areas such as green finance, cybersecurity, central bank digital currencies, and it will leverage our collective expertise and infrastructure. The individual strength of the Eurosystem's national central banks and the ECB complement each other. They make the whole greater than the sum of the individual contributions. And I'm very much looking forward to bringing the Eurosystem Center to life with you. Thank you.
Thank you. We will now move to President Weidmann, who is joining us from the Frankfurt premises of the BIS Innovation Hub Eurosystem Center. It's good to get a glimpse inside this space, which we hope will be occupied in early 2022. Over to you.
Thank you very much, and good morning, dear colleagues, dear guests. Astronomy illustrates the vast distances which international collaboration can take us. Scientists have combined the signals of radio telescopes around the globe, thereby creating, in essence, a virtual telescope multiple times the diameter of the Earth. The resultant resolution would make it possible to identify a €2 coin on the moon, a level of detail which is unimaginable for a single telescope. Similarly, in the midst of the digital revolution, central banks have much to gain from working together. I'm delighted that with the establishment of the new BIS Innovation Hub Center in Paris and Frankfurt, the Eurosystem will become part of a collaborative network dedicated to developing and assessing digital innovations for the world of central banking. I'm standing here at the premises of the Bundesbank's Innovation Lab and the future BIS Innovation Hub site located in the heart of Frankfurt. This open workspace is intended not only for our staff, but also for the international central bank community to foster innovation. One important area of focus is cybersecurity. As the global financial system is being transformed by digitalization, cyber attacks are becoming a major threat to its stability.
So that is Jens Weidmann, the president of the Bundesbank, speaking as part of a BIS panel, which included Madame Lagarde and others. We'll continue to monitor the panel and bring you any worthwhile lines as and when they come through. Now, in terms of data in focus today, German inflation rose at its fastest pace in almost 30 years in November, posting a harmonized increase of 6% year on year. Energy prices were up more than 22% year on year, reflecting a wider trend across Europe. The UK economy grew by a weaker than expected 0.1% in October, weaker than a pre-pandemic reading of 0.5% back in Feb 2020. UK Chancellor Rishi Sunak says the economy is well placed, but that there could be bumps on the road. The weaker numbers come as the Bank of England ponders whether to hike rates at its next meeting. Turning to European markets, let's take a look at how they're trading this morning. Stock 600 currently down about 0.5% following a subdued session yesterday. The Stock 600 ended just 8 basis points lower, so not a huge amount of movement. But coming into today on the week, the Stock 600 is up 3%, on pace to break a 3-week losing streak. So it has been a strong week for European equities, but a little bit of that momentum beginning to fade. Turning to the individual regions, this is how the regional split looks this morning. Red across the board, so fairly broad brush pullback. We've got the FTSE 100 here in the UK down by about 1/3%, 0.5% lower for the CAC 40 over in France, as well as the Swiss market, and then 30 to 40 basis points lower for the German, Italian, and Spanish markets. All right, we're going to take a quick break, but coming up on the show, a new name and a new structure. It's all change at Shell, where the company's annual general meeting has just kicked off. We'll preview what's on the agenda just ahead.
Tune in, protect Jack.
Welcome back to the program. Let's get into some of the key corporates in focus today. Bayer has won a second consecutive verdict over its top-selling Roundup weed killer. A jury in California rejected a mother's claim that the chemical giant's product had caused her cancer. Roundup-related lawsuits have dogged the company for years, costing it billions of dollars in settlements. Turning to the sectors this morning, we've got the majority of European sectors trading lower, but fairly contained moves to the downside. You've got utilities underperforming down about 1%, alongside technology and industrials. On the upside, we've got autos trading about 1/3% higher alongside basic resources. In terms of oil, let's take a look at how WTI and Brent are trading. Currently, Brent around $74 a barrel, up 20 basis points on the day. WTI and Brent on course to mark the strongest gains in 15 weeks. WTI currently trading around $71 a barrel. Now, it's a big day for Royal Dutch Shell. The company is meeting with shareholders to vote on a string of new simplified corporate proposals. Shell is vying to ditch its dual-class share structure and move its headquarters and tax residency to the UK. The company says the move to scrap its dual-class share structure would allow it to return more cash to shareholders, including through buybacks. Shell will still continue to trade in Amsterdam, London, and New York. I want to welcome to Street Signs Nick Stansbury, Head of Climate Solutions at LGIM. Nick, thanks for being with us today. Pretty substantial strategic changes underway over at Shell, and a big day for the company. Let's just kick off with your overall view of the strategic changes proposed and whether you think Shell will get approval today.
Hello, good morning. It's nice to be with you. So these changes, they sound like they're enormously important, that they should be very, very controversial, that they're going to have really big, far-reaching consequences for the company. But we don't really think that that's the case. We think this is actually a relatively routine bit of corporate simplification, a kind of corporate tidying up exercise to deal with a complex bit of historical legacy that's simply no longer needed in the world that Shell now lives and operates in.
What are these changes going to allow Shell to do that they weren't able to do before?
So I don't think these changes are going to suddenly allow Shell to do lots and lots of things that they weren't able to do before. I think it's a question of allowing them to do things more efficiently. So by unifying and simplifying the corporate structure, it will allow the company, in our view, to return capital to shareholders in a more efficient way, to give them more flexibility, and to allow them to operate in a somewhat simpler way when it comes to engaging in sort of corporate transactional type of activity. And as shareholders, generally speaking, unless there's a really good reason not to look at these sorts of simplification exercises favorably, we tend to say that simpler corporate structures that give companies more flexibility are good things.
Nick, I just want to note for our audience that LGIM is a top 20 shareholder of Shell. And there's, as you mentioned, a lot of talk now about what this will mean for shareholder returns in the future. I mean, what's the sort of pace and scale of shareholder returns you think we can expect from Shell?
So when we look forward at the next 10 to 20 years for this company and for the entire industry, we think it's really clear that the energy transition and decarbonisation are going to radically up the level of uncertainty and complexity in which this industry operates. Nobody really knows, given the huge uncertainty around climate change and the outcome that the world is heading towards, whether we're going to see continued growth in oil demand or we're going to see incredibly rapid reductions in oil demand. We hope, we would expect as a base case that oil demand is likely to start to come down and probably come down quite quickly. And in that context, for a company of Shell's size and the huge uncertainties that there are around investing in projects, new, big, potentially multi-decade complex projects, that shareholder returns and choosing to return capital to shareholders in the context of that uncertainty is clearly something that makes a lot of sense for investors. So we're excited that this industry, as it heads past the point potentially of peak oil demand and needs to invest less and less shareholder funds in generating new projects, could become even more cash generative as an industry than it is today. And today, the oil and gas industry is one of the most cash generative sectors that investors have to invest in.
When it comes to the investment needed to fund the energy transition, you're obviously head of climate solutions, so this is an area you're looking at very, very closely. where are the most important projects, and where do you want to see that cash redeployed?
So when we look and step back and we look at the energy transition through the lens of history, we can see really clearly that this is an enormous challenge, financing the energy transition. We need to deploy net new capital of somewhere between $30 and $50 trillion, $30 to $50 trillion, depending on which study you believe, into a low carbon energy system of the future over the next 30 years. That will involve rebuilding the world's energy system more than twice as fast as we think it has ever changed in over 200 years of history. And today, the world is investing, on our maths, maybe 20% of the capital that it needs to, at best, into a low carbon energy system. So where does the capital need to go? Well, it needs to go everywhere. It needs to go into renewables in vast quantities. Renewables have been growing faster than any new energy source has ever grown in human history, we think, on our numbers. But it needs to grow even faster. It's not yet making up 100% of marginal demand growth for energy globally. So until that happens, we don't yet have an energy transition. So we think the world could easily quadruple spending on low carbon energy over the next 10 years, and it would still be uncertain as to whether or not we were heading in an acceptable trajectory from a climate change outcome.
Well, on that point, Nick, around the astronomical growth of renewables, still, as you point out, we are not in a position to see renewables overtake or rid us of the need for traditional fossil fuels anytime soon. So should we reset our expectations for how long these oil giants are going to have to stick around, and how much funding is going to be necessary to funnel us and power us through this transition period?
Yeah, so there's a few ways of looking at that question. So firstly, yes, we think clearly the outlook for oil and gas demand over the next 30 years is not going to look anywhere close to what it's looked like over the past 30. This industry no longer operates in a world where demand just continues to go up relentlessly every single year, barring financial crises or economic recessions. So yes, absolutely, the oil and gas industry does not face the same sort of future in front of it as it has operated in historically. But even under the most aggressive transition scenarios, you do not see oil and gas demand disappearing overnight. Yes, the industry needs to invest less money, but oil and gas is still going to be consumed globally, almost certainly in 30 years' time. And that means that these companies are still going to have a really important role to play in providing the energy that the world needs. And that demand for energy, we think, in an absolute sense, is likely to grow. The type of energy that gets consumed will change, but globally, 50% of the world's population still consume maybe a tenth of the energy on a per capita basis that the rest of us do. So there is still enormous room to grow energy supply to the world's poorest. Maybe 1 billion people still don't have access to reliable electricity on a global level. So there's still enormous room for energy demand to grow. And even in really rapid decarbonization scenarios, you don't see oil and gas demand disappearing. You see a gradual decline in demand that hopefully takes place over a really long period of time. And these industries in that period of transition are going to have a really, really important and very positive role to play, both for us as investors in providing us with lots and lots of juicy cash flows, we hope, but also for the world, because we cannot simply switch the oil and gas industry off overnight and keep the world running.
It's certainly a compelling argument, yet I just came from COP26 in Glasgow, and there are climate activists and people who don't think that oil majors deserve a place at the table and question their role during this transition period. How do you communicate with those activists who are pushing investment away from these energy giants?
So we'd encourage anybody thinking about this issue to step back and look at the data. So the oil and gas industry globally, we think, is beginning to get to a point where it is investing in line with close to a 1.5 degree runoff type scenario. So the idea that the right thing for this industry to do is to invest even less than it is currently doing, given the fact that over the next 7 to 10 years, the likely demand for oil and gas is reasonably predictable. We can have a reasonable guess at knowing what the demand outlook looks like over the next 10 years with a reasonable margin of uncertainty around it. The data would tell us that the oil and gas industry still has a really, really important role to play in its core business. You can understand the anger, and I sympathize with it very strongly. Clearly, this industry has not always behaved in the right way when it comes to climate change. But we have to recognize the enormous progress, particularly that European oil and gas majors have made. And we need to recognize that this industry, however aggressively the world changes, has an important role to play in the energy system of the future, both as a provider of low carbon energy solutions. And we have to remember that this industry has enormous technical expertise at doing complicated engineering projects that they have been doing in some of the world's harshest and most demanding environments for decades, but also in providing us with cash flow. There are very few places in global markets where investors can go to see this level of cash generation. And the cash generation this industry can generate in a world where demand for its products stops growing and starts to decline, is going to increase. And the world needs huge quantities of cash to invest in a decarbonized energy system. So we really don't see the oil and gas industry as the enemies of a world which wants to head to a net zero future.
Nick, lastly, activist investors. Shell's had an activist turn up on its shareholder register from Third Point. Do you expect to see activists turn up in any other European oil and gas majors?
So clearly, I've no insights into whether or not more are coming. But if you step back again and you look at long-term performance from shareholder return perspectives of many of these companies, it is not particularly fantastic. This is an industry which, for many reasons, some of which its own fault, some of which not its fault, has not delivered stellar shareholder returns over very long periods of time. And therefore, it's no surprise, given that level of underperformance, the miserable returns on capital employed that some of these companies have generated, that you can see activists showing up and starting to ask for change. And I think as they do so, investors are going to be wanting to answer two questions. One, are the things that activists are asking for in the interests of shareholders over the long term, i.e., are these things going to, are companies acting on activist demands going to unlock value for long-term shareholders, not just for short-term shareholders? And secondly, and just as importantly, are making the changes that activists are asking for, is that going to accelerate and increase the scale of the positive impact that these companies can have on addressing the climate crisis? If the answer to both of those questions turns out to be yes, then there may well be increased activist activity in this sector. But both of those questions are equally as important, and activists will need to address both of them.
Nick, fascinating conversation. Thank you for sharing your thoughts with us this morning. Nick Stansbury, Head of Climate Solutions at LJM. Coming up on the show, with inflation running hot and supply chain bottlenecks showing no signs of abating, investment opportunities are becoming scarce. So where should risk takers go? Tune into our conversation with the investment management giant PIMCO after the break. Welcome back to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. Daimler Truck makes its Frankfurt debut as the truck maker completes its long-awaited spinoff. Speaking to CNBC, Daimler Truck CEO Martin Daum outlined the motivation for the listing.
The spinoff just gives us more focus, more visibility, interview like that, and going forward, a clear profile as a world-leading transportation company.
Daimler CEO Ola Källenius hails the listing a success, while also telling Street Signs its first autonomous vehicle regulatory approval is a historic moment.
So it feels, in a way, like putting the first step on the moon with this first certification, and there will be more to come in the future. This is a very, very exciting technological space for us.
European markets trade lower as German inflation jumps more than 5% in November on the year, while U.S. CPI is expected to hit levels not seen since the early 1980s. And out with the old, in with the new. Shell ditches Royal Dutch and proposes a new structure at its annual general meeting kicking off. All right, well, today is a big day in terms of inflation. We've got the U.S. November CPI due out this afternoon, and it is expected to have jumped 6.7% on the year. Now, that latest print is due out at 14:30 CET. If forecasts are correct, it would mark a near 40-year inflation high, going all the way back to 1982, when inflation came in at 9.25%. Now, only 2 years before that, Fed Governor Paul Volcker had raised prime interest rates to historic highs of over 20%, exacerbating an ongoing recession. So you can imagine all eyes are on today's print. U.S. jobless claims hit a 52-year low in the week ending December 4th, coming in at 184,000, well below most expectations. However, continuing claims were surprisingly high at 1.99 million, nearly 90,000 above the Reuters forecast. Let's take a look at Wall Street and how U.S. futures are shaping up in the lead up to this all-important inflation print. Very muted indication right now. It seems as though investors are firmly in wait-and-see mode. Dow Jones, the SP 500 looking at flat starts to the trading session. The NASDAQ looking at about a 20-point jump, but very contained. Turning to yesterday's action in bond markets, I want to just highlight that we saw both European sovereign bond yields and Treasury yields fall back yesterday. The dollar index currently on pace for its longest weekly win streak in quite some time. And now looking at Treasury yields today, we've got the 2-year trading at around 72 basis points. The U.S. 10-year, where investors are firmly focused, is trading now back above 1.5% at 1.51%. European markets, let's take a look at how equities are trading this morning. It is still red across the board, fairly contained moves. Yesterday, a subdued session here in Europe with the Stoxx 600 essentially ending the day flat. And the sell-off that we're seeing today, fairly broad-based, about 1/3% lower for the German, French, and Italian markets. Here in the UK, FTSE 100 down about 0.2%. Tech and renewable stocks will continue to be major investment opportunities in the coming year, according to PIMCO. It says semiconductor manufacturers in particular are set to benefit from ongoing inflation pressures. Geraldine Sundstrom joins us now, portfolio manager at PIMCO. Geraldine, great to have you with us. First, before we get into your asset allocation strategy for the year ahead, just outline for us what you're expecting in terms of economic growth and inflation next year.
Sure. So looking at 2022, what we see is still above trend growth, which is, a good backdrop in general for risky assets. And so what we are all worrying about, of course, is inflation and the path that central banks are going to take in light of this. It remains our forecast that inflation will gradually, eventually come down towards the latter part of 2022. And of course, in the interim, it might be a lot of raw nerves for market as central banks have to deal with this. However, we still think that, we're very early into this hiking cycle. We're still only in the middle part of an economic expansion, and therefore we still favor risk assets for 2022.
So clearly it sounds like stagflation is not something that you're particularly concerned about given the inflation outlook. Stagnation, though, is that something that you're concerned about in 2022, or are you pretty confident on the growth side?
No, we see a lot of things that are going to get better, like supply bottlenecks are going to improve, operating environment for companies is certainly going to be less complicated than 2021. Hopefully, the pandemic will ebb, and there's still a lot of stimulus in the pipe via large infrastructure plans and developments all around the world. So we still think that this, on top of consumers that still have some excess saving, that 2022 should remain a year with above trend growth.
So coming on to now your asset allocation outlook, the title is Opportunity and Transformation. So talk us through the fundamental shifts you see coming to fruition next year.
Sure. So on a secular basis, we see like some really deep transformation and potentially for most of us, the deepest transformation we have ever witnessed in a career. We have an entire world walking one walk, which is towards more green policy and more digitalization. And in a world like this, there are pockets of very large opportunities where we see not only strong growth, but barriers to entry and pricing power. And of course, semiconductors is the cornerstone of all of this because they participate not only in the digitalization, but also in the greening of the world. And it's one way, at the very root and core of everything to take a bet that will, feed through all the potential application from green energy via electric vehicle or autonomous warehouse.
In terms of semiconductors, interesting call there. I mean, there had been some talk because of the semiconductor shortage and the massive supply chain issues it's caused through the course of the pandemic, that we may see then a massive uptick in supply as capacity gets put back online and built, that ultimately we could end up with a supply glut of what is actually a fairly commoditized product. Where in this sort of semiconductor supply chain do you see the most opportunity? And what do you think about that scenario that I just outlined?
Well, for us, it's really very much the case of this time is different. We think that, first of all, the industry is extremely concentrated, in particular for the raw material, equipment, and foundry businesses. And what we see is that even though companies are preparing for higher supply from, late 2022, and then on to 2023, all the capacity is pretty much pre-booked. Manufacturers can enforce a long-term non-cancellable contract onto their clients. And we are still seeing price increase. But beyond this, this time is different because what is surrounding us and the consumption of silicon, the content of silicon around everything around us, from our electric vehicle to green power via autonomous warehouses and connected devices, is just growing at an exponential rate. And we really think that, the era of artificial intelligence, machine vision, and perception are really putting the demand for semiconductor on a completely different path. And I think this is probably where we are different from the broad consensus, which is still focusing on this boom-bust cycle, when we think now the drive is really of secular nature with double-digit growth that is going to compound over the next few years.
Really interesting. Great to get your views on the semiconductor space. What about from a regional perspective? How are you thinking about equity markets in 2022?
So when we look at the green and digital transformation, we're looking at where are the enablers of this transformation. And when we scan the world in the equities in particular, we find that the most important companies that are going to be the big actors in this transformation are to be found in the United States, but very much too in Asia. So this means that these are the part that we are overweighing in our portfolio. So United States, Japan, Korea, Taiwan, and China are ranking pretty high in our portfolio. Europe, it has a lot less to offer. Not to say that there are not great European companies. We invest in those, but generally speaking, we find the sectoral inclinations in Europe are less favorable. So, and in terms of valuation, we find still some attractive opportunities in both the US and Asia.
It's interesting from a valuation perspective that you say that, because the biggest bear argument probably to those looking to invest in the cyclical growth parts of the market in the U.S. is valuation. So why is that not a concern for you?
Well, it's true that when you look at valuation on these sectors overall, there's everything. You find some very solid established players with very strong balance sheet and strong cash flow, where we think that valuation actually do not at all reflect the scenario that we have just described. And then, of course, you have some startups, you have a lot of contenders which are coming into the field, where valuation are a lot more daunting, and where you can have a lot of question marks. So then it becomes a question of portfolio construction and how to weigh all of this. So putting more emphasis on, the promising establishing players, and maybe spice up the allocation with the contenders where you think that, the cash available, the quality of balance sheet, and the technological edge really is going to make a difference. But it's about mixing the two of those. And of course, if you go in a passive way, you might end up overweighing the sort of, big question marks and underweighting the established players. So this is where the selection and the active management comes into play.
Geraldine, fascinating conversation. Thank you. And hopefully next time we can get into your views on rates, because I know you've got a lot going on there as well. Geraldine Sundstrom, portfolio manager at PIMCO. Daimler Truck has made its debut in Frankfurt after spinning off from its parent company. I just want to give you a check on Daimler Truck. Shares are currently trading above 30 euros. We had opened at around 28 euros, so we've inched higher through the course of the morning. Annette just spoke with CEO Martin Daum earlier this morning and started off asking him how he felt about the debut price.
It's always the most important part of a spin-off, because that's really the shareholders deciding what the value of the company is, getting the shares tonight in their brokerage accounts, and it's full in the range we have expected, so no surprises here. So really glad to see the first price.
Let us look at your strategy and also the way you want to boost profitability, because there you're clearly lacking behind competitors. So what are your plans?
I mean, first of all, we have the most prestigious brands all over the world. We have a rock-solid balance sheet, and we have good profitability. Yes, we are lacking to some competitors, but only in some areas. Other areas are absolutely benchmark in the industry. So I have absolutely no doubts that we will catch up with everything else. So leading the way to zero emission in transportation, and doing that with a strong balance sheet and profitability.
So it's not your plan to start a cost-cutting program to get your profitability up?
No, we already started 2 years ago, and that has nothing to do with the spin-off. The spin-off just gives us more focus, more visibility, an interview like that, and going forward, a clear profile as a world-leading transportation company.
We were just early on discussing your way forward into making trucks cleaner for the environment, obviously. So you're having a two-fold structure, right? Electrifying and hydrogen. So what is the most important for you?
Both are very important, because the ultimate question is, how does ultimately society store and transport green energy? If we can do that everything in the grid, then certainly there's an advantage of battery electric trucks. But if we need something in between to store and transport green energy, then that is hydrogen, and therefore we go both ways.
How will that be reflected in your prices? Because clearly we're seeing that with the cars, they're much more expensive than normal cars. That will most likely also be the case, right?
This is even in bigger extent on trucks, because we need such an enormous amount of energy to get 40 tons up a steep hill that you certainly need either bigger batteries, or the fuel cells does not come for free either.
Coming up on Street Signs, Master of Its Destiny, a powerful Europe. We'll be looking at the meeting between Olaf Scholz and his French counterpart after the break.
Right now on CNBC.
Welcome back to the program. Let's talk geopolitics. U.S. President Joe Biden emphasized the U.S.'s unwavering commitment to Ukraine's sovereignty and territorial integrity in a call with his counterpart in Kiev. President Zelensky, the two spoke amid elevated tensions on Ukraine's border due to a Russian troop buildup. The White House has warned it will respond with economic and other measures should Russian aggression continue. New German Chancellor Olaf Scholz arrives in Paris today to meet with French President Emmanuel Macron. The trip will be Scholz's first in his new role, signaling a European focus for his government. Scholz and Macron have identified EU sovereignty as a key issue for their working lunch as pressure mounts on the Ukrainian border. France will meanwhile take over the reins of the EU presidency in January. President Emmanuel Macron has insisted ambitions for a more powerful sovereign Europe will be at the heart of his country's tenure, as well as a focus on accelerating the continent's green transition. Charlotte joins us now with more. Charlotte, flesh out for us what President Macron is going to look to do with this presidency.
Hi, Juliana. Well, it was a wide-ranging and long press conference by Emmanuel Macron yesterday, more than 2 hours, when he presented those priorities of the French EU presidency that starts in January for 6 months. And basically, he summed up in saying that he wants a Europe that is of cooperation within its own borders to a Europe that is a power and sovereign on the world stage. Take a listen.
If I had to sum up in one sentence the objective of this presidency, which will last from January the 1st to June the 30th, I would say that we must move from a Europe of cooperation with our borders to a powerful Europe in the world, fully sovereign, free of its choices, and master of its destiny. And that is the objective we must pursue. For the first time in almost half a century, we are facing existential questions on the climate, on the technological and geopolitical levels.
Among the many topics that the president mentioned yesterday in his press conference, he talked about the reform of the Schengen area. He says something a bit like we've seen with the Eurogroup, where we have the ministers of the different countries getting together to discuss issues for the single currency. He wants to do the same for the Schengen area in particular, and talk about a new emergency mechanism to deal with issues on the external borders of the EU, to deal with the problems that we've seen, for example, on the Belarus and Poland border. For example, he talked about reforming the budget rules. He says what the European countries are dealing with the economic recovery post-pandemic. He wants to reform those budget rules. Of course, his meeting today with Olaf Scholz, the new German chancellor, will help him discuss this agenda. He might have a more friendly ear to this than with Angela Merkel previously with this new coalition in Berlin. And of course, any alliance between France and Germany is crucial to the advancing of any agenda within the EU. Of course, this meeting today is crucial in that sense. Also, he talked about creating a new investment strategy for key industries for the future, including in hydrogen, semiconductors and the cloud within Europe, and creating some more of these European champions. He'll talk about European defense and relations with some of the key neighbors, including in Africa and the Balkans, among many other topics. So you would say it's a very ambitious program for 6 months rotating presidency of the EU, and even more for a man that could be out of the job halfway through that presidency, because of course the French presidential election is at the end of April. But look, the EU and the reform of the EU and how the France's destiny is very tied to the destiny of the EU has been at the heart of his first campaign, and he wouldn't be surprised at the heart of his second campaign. Of course, he hasn't declared that he's running just yet, but very much what we've heard yesterday seemed to be the great lines of the Macron vision of the world, with his strategic autonomy of Europe. That seems to be very much at the heart. Of course, that gives him an extra stage in this 6 months in his own electoral campaign to show that he's a powerful man in Europe, the most powerful now that Angela Merkel has left, and an extra platform to show his vision. So if anything, whether you agree with him or not, for sure, it is a very different vision from what we hear from other candidates, including Éric Zemmour and Marine Le Pen, that we heard yesterday for Emmanuel Macron. Juliana.
Charlotte, thank you for breaking it down and setting for the scene for today's working lunch. We'll, of course, look forward to catching up with you on Monday for the latest. Let's take a look at European markets now, just about 2 hours into the trading session. We started out the session on the back foot, and that's where we remain. Fairly broad-based, but contained sell-off taking shape in Europe this morning. It was a subdued session yesterday. The Stoxx 600 ended just about 8 basis points lower. For the week, though, worth noting that the Stoxx 600 was up 3% coming into today. yesterday, on pace to break a 3-week losing streak. So it has been a strong set of sessions for Europe overall. U.S. futures, this is how Wall Street is poised to open up. Subdued indication there as well. And this, of course, in the lead up to today's all-important CPI report. Ahead of that report yesterday, we did get another round of pretty robust labor market data in the form of U.S. weekly initial jobless claims. Now, when it comes to today's data print, the U.S. CPI expected to have risen about 6.8% year on year. So an incredibly high print expected. We'll see how markets react if that does come through as forecast. Well, that's it for today's show. I'm Juliana Tattlebaum. Have a wonderful weekend. Worldwide Exchange is coming your way next.
Do you need a boost in sales?
It is 5 a.m. at CNBC Global Headquarters, and here's your top 5 at 5. A stock's strong start to the week continuing to fizzle a bit on Omicron concerns and economic data. Futures are fighting for gains this morning. Key on the top of investors' minds today, inflation data out in just a couple of hours, potentially coming in at the highest level in 40 years. In Washington, the Senate clearing a key hurdle in that race to raise the U.S. debt limit with just days to get that job done. New data on the rising risks of rising temperatures and the dramatic impact on local economies, especially lower income communities, and the ongoing supply chain issues and crunches set to potentially dampen the holiday spirit this year as toy shortages leave some parents scrambling for gifts. It's Friday, December 10th. You are watching Worldwide Exchange right here on CNBC. Good Friday morning. I am Dominic Chu in for Brian Sullivan, and here's how your money and the global markets are setting their day up. Stock futures right now indicating some modest moves to the upside, but they're very stable right now. Some modest moves. The Dow Jones implied higher by just about 8 points. We're going to call that pretty much unchanged. The S&P up by about 7 handles, and the NASDAQ Composite and NASDAQ 100 up by about 28 or so points here overall. So watch those trades. Modest moves to the upside to maybe close out this week. Those major indices falling Thursday as investors digested weekly jobless claims data and the latest global restrictions targeting the spread of that COVID Omicron variant. Right now, the Dow is ending flat while the S&P dropped 0.75%. Technology was the big loser, with the NASDAQ down about 1.75%, though. Still, all three indices looking at strong gains for the week. The Dow is up about 3.5%, while the S&P and NASDAQ are up close to 3%. We also want to get a check on the Treasury market right now, with the 10-year benchmark Treasury note yield climbing back above that 1.5% mark, currently 1.5% for that benchmark 10-year note yield. The 2-year note yield just about 71, 72 basis points. So again, some moves there. The 30-year long bond, 1.88%. Let's also get a look at the crypto space. With Bitcoin back below that 50,000 mark, we seem to be moving right around these levels, hovering around that 50,000 mark. Currently, Bitcoin price is 48,490, 2% upside there. Ether prices about 0.5% upside, $4,121 there as well. Let's now go worldwide. Juliana Tattlebaum is in London with the latest look at the early trade in Europe. Good morning, Juliana.
Dom, good morning. Well, we're off to a fairly subdued start here in Europe. Every region is trading lower, but the moves are contained. We've got about 1/3% down for the German index, the DAX, the CAC 40 over in France, down about 0.4%. Here in the UK, the FTSE 100 holding up a little bit better, down by about 11 basis points. We did get some data out of the UK this morning. The UK economy grew by just 0.1% in October. These are according to new official monthly figures, despite a strong performance by the health sector and secondhand car sales, but still very muted growth. So investors digesting that. Coming into today's session, worth noting, though, the Stock 600, the benchmark here in Europe, up 3% on the week, on pace to break a 3-week losing streak. So we have had a positive run into the end of the week. From a sector perspective, this is what the picture looks like in Europe. We've got a few sectors trading above the flat line, namely autos up more than 1%, basic resources, banks, and oil and gas. On the downside, some underperformance in technology, down about 1%, retail, industrials, and healthcare. John, but investors over here are closely going to be watching that U.S. inflation print this afternoon. So a little bit of a holding pattern here as well.
Juliana Tattlebaum, live in London. Thank you very much. Have a nice weekend. Now to some of this morning's top stories. Silvana Henao is here with those. Good morning, Silvana.
Hey, Dom. Good morning. Happy Friday. Dom, so the Senate has cleared a key hurdle in the race to raise the U.S.'s debt limit. Lawmakers voting last night to allow that chamber to raise the borrowing limit with a simple majority. That measure now heads to President Biden's desk for his approval. The Senate and the House will now have to hold separate votes to increase the debt ceiling. Both chambers are expected to do so early next week before the Wednesday deadline to do so. Volvo has announced a new partnership with battery manufacturer Northvolt to open a research and development center as well as a new manufacturing plant in Sweden. The move is part of a more than $3 billion investment by the automaker, and it follows the announcement made by the pair earlier this year, saying that they would form a joint venture to develop and produce sustainable batteries to power electric Volvo and Polestar cars. and shares of Beyond Meat getting grilled in the pre-market after Taco Bell reportedly canceled a planned test run of a product featuring the company's alternative version of carne asada. That's according to Bloomberg. The Yum brand's fast food chain was not happy with samples of the product back in October. The report adds that another test run could still happen. Beyond Meat announced in February that it had a multi-year deal with Yum that also included the company's KFC and Pizza Hut chains. Dom.
All right, Silvana, thank you very much for that. Back on Wall Street, investors are bracing for the latest read on November inflation. Estimates from Dow Jones are calling for a 6.7% rise in consumer prices from the same time last year. A read, by the way, that would be the highest since June of 1982. And if you strip out the cost of food and fuel, prices are expected to have risen about 4.9% year on year, a read that would also hit multi-year highs. In this case, the highest reading since June of 1991. Either way, you get the idea. Consumers are getting hit hard. Just listen to what Hormel Foods chairman and CEO Jim Snee told our own Jim Cramer on Mad Money last night.
A number of our inputs have started to moderate for a number of our products. But I mean, when you think about the labor increases that we've had, increases in our packaging, other supplies, getting the product shipped, as you mentioned. I mean, that inflation it's real, it's significant, and it's being passed along in the form of higher pricing.
All right, though, while the consumer gets squeezed, for stocks, it's all about the Fed and what it might do in the face of a white-hot read when it comes to its plans to taper bond purchases in what could be the first interest rate hike in years down the line. Joining me now is Mark Fleming, chief economist at First American Financial. This has been a double-pronged attack for investors that they've had to deal with for a while. The concerns about Omicron and then the concerns about inflation in the Fed. Which in your mind is going to be the biggest dominant theme in the coming, say, 6 to 12 months?
I think the theme from the market's perspective will clearly be the Fed. We've had a decade now of extremely low accommodative monetary policy, both tapering and low rates. The accommodative policy tapering will go away, and probably we will pull forward the rate increase. But I don't know that that necessarily affects things or affects the real world. I mean, what's going on is supply shortage and things like that affected by the pandemic and Omicron again. The Fed has a lot less ability to measure that. And I just looked up this morning, 10-year yields at 1.5% with inflation now around 6 or 7. In 1981, 82, when inflation was this high again, the 10-year yield was over 10%. So there's a big disconnect there.
So there's a big disconnect, no doubt, Mark. But a lot of that, and it's rightly pointed out, a lot of that has to do with the Fed itself, right? We're still in pandemic-era policies. And forget about that. We're still in great financial crisis recovery policies going back to 2009, 2010. So maybe the policy normalization, is it long overdue? Or can we expect volatility to happen just because we haven't seen any kind of real normality to interest rates or monetary policy in years?
I've forgotten when normal last was, actually. It seems like maybe this is the new normal. It's, like you said, 10 years of it. But absolutely, I think it's time, it has been time to remove certainly the tapering. If you look at the long yields on bonds and you look at mortgages, which are reflective of bond prices, in the housing market with house price appreciation so high, we don't need accommodative monetary policy in places like the housing market, and we haven't needed it for a while. So overdue, possibly. The impact, I think, will be whether it can actually bring down inflation, and that's much more difficult. Raising rates and removing the policy that's so accommodative doesn't necessarily immediately translate into lower inflation, because a lot of that inflation is driven by things in the real economy, less the financial economy.
Mark, I mean, let's talk a little bit about this notion here that inflation, it is a real threat. There's no doubt about it. We've been feeling it everywhere. And it doesn't matter what you buy, things are going up in value. But how big of a threat is it down the line? How persistent do you think it is? I'm trying not to use that T word that Fed Chair Jay Powell is trying to get rid of, get out of the lexicon now at this point.
Right. Temporary or transitory or not, I think one of the most interesting things about inflation at the moment is we always used to believe that what really made it come to bear or hold for the long run, in other words, not be transitory, was expectations. And expectations about inflation in the future would drive your desire for wages now, and you get this wage inflation spiral concept. But there's interesting research that now says maybe that doesn't come first. And so it's the chicken and the egg problem. Does expectations drive current inflation now, or does current inflation drive expectations? So research says now we're not quite clear on whether it's the chicken that came first or the egg that came first. What that means is we really are having a hard time trying to understand as economists whether it will hold for the long run or not. It's sort of the great unknown at this point. But like you said, it's clear it affects the individual today, and we're seeing that prices are more expensive. I find it interesting that we take out food and fuel. That's probably some of the most important things that people see in their own experience, and that's where they feel and begin to expect what prices will look like.
Two of the things I really only have to spend on, food and fuel for me. Mark Fleming, thank you very much. Have a nice weekend.
Thank you.
When we come back on the show, check out what's happening with the metaverse. The stocks Jeffrey says could get a big boost as we shift into the virtual worlds. Plus your morning's big money movers, including what's taking a bite out of shares of one e-commerce company in that mystery chart right there. And then later on, Elon Musk unloading more shares of Tesla. Details on how much more of the stock he's sold off. We've got a very busy hour still ahead when Worldwide Exchange returns after this.
We put
Tip of nearly everyone's tongue in technology, metaverse. And while the company formerly known as Facebook appears to be the poster child for what could very well be the next internet, many other companies are only just dipping their toes into the water right now, but that's not stopping some on Wall Street from firming up and firing up some of those buy signals on a technology they say could disrupt human life as we know it today. Joining me now is one of those meta bulls, Simon Powell, Global Head of Thematic Research over at Jefferies. I'm seeing you, and you're actually a person. You're not an avatar. So, Simon, how big of a person, a metaverse person could you be if I don't even see you in a kind of characterized format right now?
Yeah, look, I think the way to think about this, Dominic, if for those of us who were around in the late 80s, that's and asking what is the internet going to be, that's kind of where we are in 2021, asking what can the metaverse be. So we can only imagine what it can be. And at one end of the spectrum, it can be highly transformative and highly disruptive. The way to think about it is all human activity that hasn't moved online is about to move online in the next 5 to 10 years. And you'll be able to choose whether to live your life entirely in a digital world or in this hybrid of digital and physical.
You know, Simon, it's interesting because if there was a company, I would say, that is so well positioned for this, it would be Facebook's now Meta platforms, because I remember the early days of Farmville, when people used to go online and buy and spend money on things like virtual sheep and cows and tractors and equipment and everything else. But just how big of a deal is this, and how do companies cash in, and who's going to be doing it?
Well, the point you raise is interesting, and the question as to whether Facebook or other big tech players are going to dominate this or not is up for grabs, because when you talk to people building things like the Sandbox or Decentraland, at the heart of their version of the metaverse, is decentralized Web 3.0. So it's not controlled by one company; it's controlled by the group. It's linked to the blockchain, and it sits on decentralized servers. So I think that debate is still up in terms of whether it's going to be decentralized or centralized.
So if you were to say you're going to make an investment thesis out of the future of the metaverse, where would the core portfolio be? Would it be Meta platforms? Who else makes up the infrastructure of what could be this metaverse, this kind of decentralized peer-to-peer world of interacting? And because we know, I mean, everybody kind of comes in on the periphery, right? Brands can get in some ways by selling goods, that sort of thing. But who makes the backbone of what you think the metaverse will be?
Well, you touched on it. So take yourself back, and I was around in the late 80s. Take yourself back. What did you want to own from 1989 to 2000? You wanted to own the Ciscos of the world. And I think the same is going to be true for a metaverse. So you want to think about the chip makers. This is going to require a huge amount of computing power. You're going to want to own the device manufacturers, the people making these VR headsets. It's all about infrastructure for the next few years. Then it moves on to software, who's going to develop the technology and the platforms, and then it moves into the use cases. And I think it will follow a similar route as we saw internet late 80s into the noughties, into the last decade, where it was all about business cases and use cases. I think the metaverse could play out in a similar way.
So Simon, so who are those companies? Is it NVIDIA? Is it AMD? Is it Cisco again? Is it Sienna? Is it who is it that does this stuff?
It's all of the chip makers that you mentioned, because the computing power required to get us into this metaverse, the amount of artificial intelligence that's going to be needed to create digital twins that are going to represent you in this metaverse, that computing power probably is more than we've previously envisaged. So if you think about, sell side predictions for what's needed on chipsets required for mining cryptos, and then throw in a bull case on the metaverse, there's significant potential upside from a computing power perspective. So it's definitely chipsets. It's definitely 5G. It's definitely much more server farms. It's much more cloud. It's just much more computing grunt that's needed as a backbone to give you this three-dimensional immersive world. And then it's all the stuff that's happening in virtual reality headsets. So take a look at the Oculus. Look how quickly it's selling. Have a look at what potentially Apple might bring to the market in 2022 in terms of a VR headset.
All right. Simon Powell with the latest on the metaverse there. Thank you very much. Have a good day.
Thank you.
Still on deck for the show, the other word outside of metaverse on the tip of everyone's tongue these days is, yes, inflation. As Google tells employees higher pay is not on the way to help with rising prices.
Today's big number, 391. That's how many IPOs have priced this year, according to data from Renaissance Capital. That's up about 90% from the same period last year. The CNBC app.
Time now for your big money movers, 3 stock stories of the morning. Stock number 1 is Chewy. Those shares are falling after the pet e-commerce company reported a wider than expected loss for the third quarter, as well as a miss on new customer additions. Revenue, though, did match estimates. Chewy citing supply chain disruptions, labor shortages, and higher inflation for the weaker numbers. But its CEO telling our Jim Cramer last night on Mad Money, there are improving signals on that front.
The port congestions are starting to alleviate, so that I would put to be a near-term, constraint. And then labor and material is anybody's guess at this point, and we're essentially reacting to something like that in real time.
All right, so keep an eye on those Chewy shares. They're down about 11% right now in the pre-market. Stock number 2 is Oracle. Those shares taking off after second quarter earnings and revenues topped analyst expectations. Oracle also forecasting an upbeat third quarter, citing a rebound in IT spending, and those shares are up 11% in the pre-market trade. And then stock number 3 is Broadcom. Shares are also climbing higher on its fourth quarter earnings and revenue beat as well. The chip and software company also providing strong guidance for the quarter ahead and also raising its dividend while also announcing a new stock repurchase program. All kinds of things happening. That's leading to a net 6% gain for Broadcom in the pre-market trade. Well, still on deck for the show, your exclusive look at the biggest insider buys, including the largest stock purchase ever seen as a part of this weekly segment that Brian does every Friday. Here's a tip. It's by one of Facebook's founders. We'll be right back.
Tune in for Tech Jack.
fighting to regain its footing this morning as investors gear up for that very critical inflation number out in just a couple of hours. Facebook facing new pressure from Congress as another senator calls for investigations into the tech giant. And Elon Musk selling even more shares of Tesla stock as the CEO continues to unload his stake in the EV maker. It is Friday, December 10th, and you are watching Worldwide Exchange right here on CNBC. Welcome back to the show. I am Dominic Chu in for Brian Sullivan. This is Worldwide Exchange, and here's how your money and investments are looking as we are halfway through the 5 a.m. Eastern time hour. Right now, stock futures are pointing to gains, but they're modest ones. The Dow is implied higher by just about 1 point right now. The S&P higher by about 6, and the NASDAQ by about 18 to 19. Now, the major indices falling Thursday as investors digested weekly jobless claims data and the latest global restrictions targeting the spread of the COVID Omicron variant. The Dow ending the day pretty flat, while the S&P dropped 0.75%, as you can see there, and the big loser was the NASDAQ, down about 1.7%. Still, though, all three indices are looking at strong gains for the week. The Dow is up roughly 3.5%, and the S&P and NASDAQ are up nearly 3% at this point. Let's dive into the sectors with a look at the three sectors that are in big focus up for at least this week here. Technology and energy. On a year-to-date basis, you can see some of the big gains there. Those two sectors were the biggest gainers over the last 1 week period. Meanwhile, consumer staples, an underperformer so far this year, was also the worst performing sector over the last week. But here are the moves on a year-to-date basis to kind of show you some of the context that we're talking about. That real cyclical trade, economically sensitive one, is starting to come to life again, at least in certain parts of the market. Now, turning to the mega cap technology trade and communication services trade that has been driving a lot of that. Take a look on a 1 week basis at shares of Apple, Microsoft, and Alphabet, the three biggest stocks in the S&P and the NASDAQ. They've been driving a lot of the action. And in particular, that white line for Apple up 7-8% at this point. It has been seen in many different lights over the course of the last couple of weeks during bouts of volatility to the upside and downside. Is it a safety trade? Is it a growth trade? It seems to have been both at one point or another over the last week. We'll keep an eye on Apple shares. Let's get more on the markets overall and where the options action is. For that, we bring in John Najarian, Market Rebellion co-founder, also a CNBC contributor, a guy you'll see a lot on the halftime report. John, thank you very much for being here this morning. What's caught your eye over the course of the last week? Has it been that mega cap tech trade? Have you seen a lot of activity there?
We certainly have, Dom, and you're exactly right. You talked about Apple and how it helped lead tech back. It held on to those gains yesterday. That was very impressive to see Apple. It was either within 10 or 15 cents of up or down at the end of the day yesterday, Dom. And that's pretty impressive given the just whack that a lot of people gave to some of those mega tech names, mega cap techs. So Apple, they continue to bet on upside calls all the way out to nearly Christmas, Dom. So not just very, very short term like December 10th today, but out a week, out 2 weeks, all the way to the end of the year. They're betting that 175, 180, 185, those are all numbers. And you and I both know why, because anything over, 182, Dom, puts it at a 3 trillion market cap. I think that's part of what is driving it. But then it's speculation on the EV that they may be involved with, whether they make it on their own or not. I think that's a lot of the spec that's got Apple shares just bubbling higher.
So we know that there's certainly a lot of retail and institutional interest in Apple specifically. I mean, it's a magnet. It's the biggest company out there, and it gets a lot of traffic. Mm-hmm. Where else are you seeing it? Is it just in some of those mega cap names, or can we go down the spectrum here into other parts of the tech and comm services market that you feel as though are getting more attention now that have not been getting the attention that Apple has over the last several months now?
Well, earlier in the week, Dom, Snapchat, for instance, whether or not it was what Kris and her daughter Kim Kardashian are doing with Snapchat right now, whether that was something that people either anticipated or knew about and the stock made a pretty decent pop and held on to it again, like Apple. I think it was only down about $1 yesterday. And it made a somewhat dramatic move, let's say 47 to 52 in 2 or 3 days. I mean, that's a pretty decent pop. That's not a mega cap, but we all know sort of the troubles that Twitter has had of late with Dorsey departing and with people wondering what's going to be happening with socials in particular, you know, whether it's Meta or whether it's something like Snapchat. People are willing to speculate on some of those names, Dom. I'd also point out that Oracle, you know, which used to be one of the mainstays, just like Apple is now, that we'd always talk about. If you spoke of tech and you didn't speak of Cisco and Oracle, you weren't really talking about tech. But Oracle, there was a lot of upside speculation and calls. Obviously, they blew out the earnings. What was it? We had the December 90 all the way up to the 94 calls. I think the stock touched 100 in the after hours last night. And that just kind of shows you that people are still, even on a week where you're up 3.5%, you've got people betting on some of these stocks into earnings, and they were richly rewarded for that, on that bet anyway.
You know, John, I mean, Oracle has been one of those, you know, it's not that we don't talk about it. It's almost a $250 billion company now, a software giant. But it's been the steady performer that's just gone up and up and up. It's up like 37%, I'm looking year to date for shares of Oracle. Mm-hmm. There have been trades like that throughout the course of this market that have arguably rewarded and compensated investors in a way that could have at least stemmed some of the effects of the inflation that we're seeing on the consumer front. You look at the inflation number we're expecting today. You look at the stock market overall. Do investors have to be in the stock market just to counter the effects of inflation?
Well, certainly if they have the money to be in the stock market, and it doesn't take millions, obviously. But that's why ETFs are so popular, quite frankly, because a lot of folks with $1,000 to invest on up to $5,000 or $10,000, it's really difficult to trade, you know, a single share of Apple and a couple shares of Microsoft and Amazon and things like that. So I think I get it. That's why Cathie Wood did so well in the past years. It's why a lot of those ETFs or exchange traded funds in the tech sector, even my buddy Kevin O'Leary, I think he had one of the hot tech stock plays last year for an ETF. And it just really rewarded any investor who was in there without having that much deeper pockets that you need to be fully invested in the stock market. But yeah, you're making a great point, Dom, that it certainly has been a great way to offset 6% inflation, which is, you know, the number we had last quarter was what, 6.2% or something like that. If you want to offset that, you need some sort of asset that's appreciating. If you're a renter, you're not getting it from your house. So the stock market is probably the next best place.
All right, John and Jerian with the call there. Thank you very much. We'll see you later on today, John. Appreciate it.
Thank you.
Now to this morning's top stories. Silvana Henao is back with those. Silvana.
Hey, Dom. Democratic Senator Elizabeth Warren is calling for federal regulators to open criminal and civil investigations into the company formerly known as Facebook. Warren says she wants the Justice Department and SEC to focus on allegations the company misled advertisers, investors, and the public about public safety and ad reach on its platform, and whether that violates U.S. wire fraud and securities laws. The call by Warren comes a day after fellow Democratic Senator Maria Cantwell called on the FTC to investigate whether Facebook violated the agency's law against unfair or deceptive business practices. Sticking with tech, Google executives are acknowledging worker worries about inflation, but say they have no plans to boost pay to help combat rising prices. CNBC has obtained audio of a special meeting earlier this week that was focused on the company's strategy for next year, in which the question was raised. Executives said while they are paying high labor costs, they have shot down the idea of company-wide pay adjustments. And Elon Musk continues to unload shares of Tesla. According to new regulator filings, the company's CEO has sold another $963 million worth of Tesla stock, marking the fifth straight week he sold shares. Meanwhile, Tesla has been sued by a second female employee over claims of sexual harassment. Both lawsuits allege a hostile work environment against women at Tesla's U.S. factory. Dom?
All right, Silvana, thank you very much for those headlines there. Turning to the ongoing supply chain crisis, now bleeding into the holiday toy retail scene. The Toy Insider reporting that some of this year's hottest toys are not available online, leading consumers to actually frequent more local brick and mortar stores rather than the big e-commerce players like Amazon and Walmart. Joining us now is James Zahn, senior editor of the Toy Insider, with the update. James, what exactly is the hot toy right now that you cannot find and that you have to go to these local stores to get?
Absolutely, without question, Moose Toys has the Magic Mixies Magic Misting Cauldron. That has been in and out of stock everywhere since it first hit the scene in October. Very hard to find right now. And there's a couple of other items, too, that are really hard to find. The LOL Surprise OMG House of Surprises, Spin Master's Bat Tech Bat Cave. There's a few items that are really hot, and you're just not going to find them unless you're very lucky.
So James, if you take, I mean, these things are, as a parent, I've got two small children. I'm looking for some of these things if I can find them. What exactly then has been the impact of these supply chain issues on shelves? And is it regional? Where exactly can you find things or not find things? Do you just say that the e-commerce players are the ones that are most impacted by this? What exactly is I guess the huge ripple effect that this has had on the toy business?
So, the overused word is unprecedented, but it really is, because going into fall, we thought we were going to see these mass outages, and what it became was this regional thing where you'd go to a Target store in Illinois and find packed shelves, but then a Target store in New York was completely empty. It was all of the domestic issues with trucking and rail and such that had really kind of exacerbated the whole issue across the country. But then now we hit Black Friday and Cyber Week, and all of the major players started getting huge shipments of inventory. It was like literally the ships had come in, because Walmart and Target, of course, chartered their own vessels. So all of this merchandise has started showing up in the past couple of weeks. So now here we are, second week of December, and the shelves are getting packed with merchandise that should have been here September, October. So there are great toys on the shelves at brick and mortar, but a few of those top hot items, like we discussed, are going to be really hard to get because they're already floating around the secondary market, the flipper market, scalpers. That's a huge deal right now. So those products are hard to come by, but at the same time, you're not going to go out and find, oh, the shelves are empty and there's no Christmas. There's lots of great toys out there.
All right, James on at the Toy Insider with the details on how supply chains are being impacted. Thank you very much, and good luck this season.
Take care.
Coming up on the show, Diana Olick has the latest installment of her Rising Risks series and new data on the economic disparity that communities are facing as a result of climate change. Well, What Exchange is back after this. Just released to CNBC, shedding fresh light on the debate over whether rising temperatures are impacting lower income communities more than wealthier ones. And the data has big implications not only for the health of residents, but for the health of local economies as well. Our own Diana Olick explains in her continuing series on the rising risks from climate change.
On a searing summer day in New York City, volunteers fanned out in cars with special sensors tracking both heat and humidity, from the crowded tenement and truck-lined streets of the South Bronx to the open avenues of Manhattan's Upper East Side. By mapping so specifically, they were proving that poorer neighborhoods are hotter.
As community members who actually fight for justice and social justice and environmental justice, we can now say there is actual data that says we see, and feel heat differently than everywhere else.
Bronx native Melissa Barber has fought for everything from community gardens like this one to redesigning the Bronx waterfront to literally cool the area around it. Now, working with Columbia University researcher Liv Yoon, she's using heat mapping to make a case for change to local officials and real estate developers.
How our data will differ from pre-existing data is that we are getting extremely granular data, like street level data, whereas what right now exists is satellite imagery.
The heat trackers told a striking story. On one afternoon in July, there was at least a 7-degree difference between the South Bronx, one of the poorest parts of New York City, and the Upper East Side, one of the wealthiest. The difference was even wider between the South Bronx and Central Park.
So historically redlined areas, certainly they have less infrastructure that is conducive to cooling. They have less green spaces. I mean, this is an exception in the South Bronx.
When we experience heat here, many times we experience it anywhere from 10 to 15 degrees hotter.
The sensors were provided by Oregon-based Kappa Strategies, a climate data and analytics firm that works with the federal government, local municipalities, and nonprofits.
It's really important because heat is one of the most insidious killers in cities. It kills more people than any other natural hazard.
And he says climate change is upping the ante as local economies now shut down more often due to deadly heat.
We're seeing greater intensity of heat. We're seeing longer durations of those heat waves, and we're seeing more frequent heat waves come through. And yet we're still using one single number to tell us what the temperature is for a city or a region.
The data helps communities target their financial resources toward reducing temperatures. For example, like creating more green spaces, lighter colored rooftops, more space between buildings, and more cooling centers.
We want to empower the local citizen scientists who participated so they own the data.
New York is one of 12 cities participating in the heat mapping campaign, which is in conjunction with the National Oceanic and Atmospheric Administration. The findings also show that the hotter it gets, the greater the heat divide, and temperatures are rising. Of course, globally, last July was the Earth's hottest on record. Dom.
So Diana, why is this data so valuable in the hands of certain people out there, maybe like real estate developers? You mentioned this idea that you have to space out buildings, you have to kind of change the way you zone things. How exactly then do developers use this data?
Well, because they're the ones who are going to be able to make the change. Cities are only going to be able to do so much. And developers are always looking for that next great hip neighborhood, right? If they can look at this data and prove and say that by redeveloping, adding those green spaces, making the buildings set in a different way so that there's more space between them, they can make that case that this neighborhood is going to be more valuable, not just more healthy, but more valuable to their investors, but also to the city as well. And that could help form these partnerships that would be the one way to change all this.
The evolution of business and real estate because of things like climate change. Diana Olick, thank you very much for that. We appreciate it. On deck for the show, Oppenheimer's John Stolfus lays out the trading day ahead as we await that critical inflation data for consumers. And if you have not already done so, please follow our podcast. If you miss Worldwide Exchange, check us out on Apple or Spotify or your podcast app of choice. Worldwide Exchange, audio format. We'll be right back.
Right now on CNBC.
Back to Worldwide Exchange. Time now for your weekly exclusive insider buying segment where we highlight the top 5 stocks being bought the most by their C-suite level executives with their own money. As always, the data comes from insiderscore.com. And as always, we are counting you down from number 5 to number 1. Number 5, Best Buy. Its chairman buying about $2.1 million worth of stock as the stock came down in price from recent highs. So a Best Buy buy. Number 4 is Dick's Sporting Goods. Its executive chairman, who was recently the CEO of the company, steps up with his first buy in 7 years, buying nearly $3 million worth of Dick's shares. Number 3 is DocuSign. Its CEO stepping up, first ever insider buy, picking up just under $5 million worth on that recent weakness in DocuSign shares. And a note, he was a seller at $230 per share earlier this year. The number 2 stock on the list this week is Allegheny Corp, a $5.5 million insider buy by the incoming CEO of Joseph Brandon. Has been an insider, by the way, for a long time, though. This is his first buy since 2012. And the number 1 this week, Asana, biggest ever insider buy we've seen in more than a year. CEO Dustin Moskovitz going big, buying about $89.2 million worth of Asana. He's now bought more than $400 million worth of his own stock over the long term. This stock was at about $143 a share just about a month ago. Check that out, Asana. There you go, the names. Best Buy, Dick's, DocuSign, Allegheny, and Asana. So we do this almost every Friday, and it's a segment you will only see here on Worldwide Exchange or on CNBC Pro. Brian Sullivan's all over these insider transactions. Keep an eye out for those every single Friday. Well, back to the broader market. Stock futures right now indicating some slight gains at the opening bell. The Dow's implied higher by just roughly 8 points. The S&P about 6 points, and the Nasdaq higher by 21. This has investors await what could be the highest year-over-year inflation read since the Ronald Reagan administration. Yes, Reagan was in the White House, 1982. Joining me now is John Stolfus, Oppenheimer Asset Management Chief Investment Strategist. How worried should we be, John, about the inflation picture? Do people, I asked John Najarian earlier, do people need to own stocks to hedge against inflation?
Dominic, we would certainly say that people need to own stocks here. In our viewpoint, stocks are excellently positioned, diversified, and a diversified portfolio representative, we think, of growthier value and garpier growth. We think is a good way to position for this. In the fourth quarter, what we've seen is technology, consumer discretionary, and materials have been the best performing sectors in this fourth quarter thus far. And we think that that's the way we need to roll, considering where the economy is moving towards the next new normal. Inflation should be, the T word. Well, we have to say we think inflation will come down next year as the supply chains begin to heal better.
You know, it's interesting, John. I going back to the early days of my Wall Street career, back during the dot-com era, people referred to GARPier type things, growth at a reasonable price. But back then it was hard to find growth at a reasonable price being the key. And then today, a lot of people complain about finding growth at a reasonable price. Where is there the reasonable price in the market?
Well, we'd say you got to look. You have to really dig, but we think it's in growth at a relatively reasonable price. And we feel that you find it in core technology, and you find it in a combination within consumer discretionary of companies that are involved in bringing together bricks and mortar and e-commerce. We also think you need to own value meantime, because the value should really pick up in here. And we think you want to own energy, you want to own materials, and you want to own the financials as well, because we'll get a steepening yield curve we expect next year, but not dramatically so.
So that how exactly do you position the portfolio if you're looking at all of those different pieces? Are there certain places that you want to be more exposed to? You mentioned the crossroads of e-commerce and brick and mortar. You mentioned some of the backbone type stocks. What's the overweight there?
Well, Dominic, what you want to consider in that overweighting, for instance, in technology, you really want to own the chips. semiconductors very important. I mean, you heard John Najarian a little bit earlier. We certainly agree with that. And then your guest who was talking about the metaverse ties that all in together. The metaverse may be a little bit early for investors to look at this point for more conservative investors. But at this point, what we like to say is you want those core technology names that are every day in your life. And because I manage money for the firm, Oppenheimer does not want me disclosing individual stocks that we own at this time. But what I can tell you is they're the name. Just think of the names that you're familiar with, and the ones that are profitable, that have excellent cash flow, and that bring innovation to the table, whether it's through acquisitions they make or expanding the services that they offer.
So, John, if inflation is not exactly as transitory, and we do think that the Fed is going to raise rates, would you now be just cyclically underweight bonds in the coming months and years?
Oh, well, we have been cyclically underweight bonds in the portfolios that I manage for several years now. We have not been believers that interest rates are going to rise significantly, but we do expect them to rise to a more normal level, but within that new normal concept that we've come to live with since 2009. And as a result of that, we just think for bonds to feel comfortable, you have to be short on duration, or you have to look for bonds that within credits that have an opportunity to see the credit rating improve and some potential for capital appreciation, because the coupons just don't satisfy our need for growth.
All right, John Solfis at Oppenheimer, thank you very much. Have a nice weekend, sir. That does it for us here on Worldwide Exchange. Squawk Box picks up the market coverage coming up next. Have a great weekend, everyone.
A news story has
don't sit in offices. Oh, wow. For us, this is our office. That is huge.
What is that thing? Meet the adventure capitalists. 3 extreme investors ready to put their own money behind the next great business idea for the great outdoors.
This product is a 12 out of 10.
In each episode, entrepreneurs will pitch their concept.
This is a personal shark repellent.
Hoping for an investment that will transform their small business.
I emptied out my 401k to do this.
Into an outdoor phenomenon.
I'm looking for 500,000. But it has to work.
The adventure capitalists will put each product to the test.
This is ridiculous.
Then try to make a deal.
$100,000 for 50% of the business.
Or walk away.
I'm losing confidence. I'm gonna have to walk.
Who are the investors? Jeremy Bloom, the only athlete to ski in the Winter Olympics and play in the National Football League. He raised over $42 million of venture capital for his software company, Integrate, and was named one of Forbes magazine's 30 most influential people in technology under 30.
Biggest concern is that you've never built a company.
Craig Cooper, a passionate outdoorsman, fitness author, and telecommunications entrepreneur who co-founded Boost Mobile USA and led a multi-billion-dollar energy company in Australia.
I'm not confident it's in their DNA to build a brand.
And Tahani Jones, a former linebacker who played 11 seasons in the NFL and co-founded the private equity firm Key Capital, investing in companies with a combined worth of over $100 million.
From a marketing perspective, that story needs to be tight.
These are the adventure capitalists. The adventure capitalists have just arrived in Southern California's searing Mojave Desert. Its diverse landscapes of salt flats, sand dunes, and colorful hills make it a perfect place to test the next great breakthrough outdoor product. First up is entrepreneur Angela Lee, founder of Shoulder and the creator of the Hydro Sport Vest, a wearable hydration solution for backpackers and runners. It's time for the investors to hear her pitch and possibly make an offer that could change her life forever.
Morning.
Good morning.
Morning.
Good morning.
Welcome to the Mojave.
Well, my name is Angela Lee. I am from Omaha, Nebraska, and I'm the creator and founder of the Shoulder Hydro Sport Vest. I grew up on a ranch in western Nebraska, and so being outdoors is part of my nature. My parents took us road tripping everywhere from Colorado to the desert, and it's a part of me, and I enjoy being out in it. Being on trails and watching people, I would always pass people carrying the water bottle and carrying the cell phone and nowhere to put it. And it dawned on me that there was an opportunity to create a different kind of product that could carry the necessities in a comfortable way. At Shoulder, we make scarves with pockets as well. And last year was a very difficult year. I thought I was going to lose my company. We had overstocked on inventory that we had paid a premium for, and I had lost a salesperson, but my parents have been a huge support system for me since the very beginning, and I wouldn't be here today without them. I'm here to shed light on a common nuisance that we've all experienced while working out. I like to call it occupied hand syndrome. You have a water bottle in one hand, cell phone, keys in the other, but where do you put it? Back and waist packs are cumbersome and they're difficult to access while on the go. There just hasn't been a better solution until now. Introducing the patent-pending HydroSport Athletic Vest. Perfect for running, hiking, biking, and even a walk with your best friend. Here at my shoulder, I have my cell phone. Here is our main zipper pocket where I can store items that I need, such as